to looking at the markets with David Moadel, there's an old debate about averaging down. Should you do it? Should you not do it? Well, let's examine that right now. First of all, what is averaging down? To average down means to put more money into a trade when the trade goes against you. Like when you buy a stock and it goes down, you could respond by buying more shares of that stock. Averaging down has the advantage of reducing your cost basis, meaning that you would be reducing the average price that you paid for the stock. For example, let's say you bought Apple stock at $130 per share because you thought it was a bargain at that price. But then Apple stock goes down to $120 per share. You could average down by buying more shares of Apple stock, because if it was a bargain at $130, then it's even more of a bargain at $120. So that's the argument for averaging down. So here's the argument against it. Opponents of this averaging down strategy might say that it's a mistake because you're throwing good money at a bad trade. They may say that you're fighting the trend, which is not a good idea. Sometimes you might hear the derogatory saying, losers average losers. And I'm not saying that, but I've heard people say that before. The idea behind this derogatory saying is that you should admit your mistakes and cut your losing trades short, not add to them. So here's my opinion, and I'm not going to tell you what to do or what not to do. This is just what I do for myself. I only average down if, and it has to meet all three of these requirements. I only average down if you have a medium or long-term time frame for the trade, meaning you're prepared to give the trade plenty of time for the stock to come back up. For example, if I'm trading stocks or options and I'm willing to give the trade months or even years possibly, okay, then I might consider averaging down. And you can afford to lose more money if the stock just keeps going down further and further, which is always a possibility in any stock, really. So, I ask myself, can I afford to throw more money into this trade and lose that money possibly? And also, only if the stock represents a really great company with a track record of recovering from pullbacks. So if it's not a stock that has been around for a long time and has lots of capital, lots of resources, great leadership, and a really great track record or a history of being able to recover from drawdowns or pullbacks, then I would not throw more money into the trade. Otherwise, if it does not meet all of these requirements, I do not average down. And sometimes, even if it meets all of these requirements, I won't average down. Okay, so it has to at least meet all of these requirements, and sometimes more. Sometimes, all these things are not even good enough for me to put more money into a trade. If I have any doubts in my head, if it just doesn't feel right, then I will not put more money into a trade. All right, so maybe this will inspire you to have some really strict requirements yourself before you start throwing more money into a losing trade. Many times, in my opinion, it's just not worth it. It's I'm better off a lot of the time just admitting that I made a mistake and just exiting the trade, because there will always be other opportunities. Alright, so if this was helpful to you, then please give this video a thumbs up on YouTube and leave comments. And also please subscribe to my YouTube channel so you can receive the latest updates on my financial educational videos. Also, you can contact me at any time if you have questions, comments, or you'd like to get some help putting together a trading or investing plan, because you really need to have one. You can email me at any time. My email address is davidmoadel@gmail.com. Thank you so much for watching and listening, and I'll talk to you again soon.
Thank you for watching. Please like, comment, and subscribe. And I'll see you next time.